Today, we want to take a minute to review some of the most recent, really historic dislocations inside of the energy market. So we know what's happening news-wise with the restriction or outright stoppage of flows in and out of the Persian Gulf and the shuttering of capacity in that region of the world as well. And it's showing up in the markets. So let's take a review of that, but maybe start with a few definitions so we make sure we're all on the same page. So the first is, what is a price of a barrel of oil? And there's a couple different answers for it. The one that you're probably most familiar with is the futures price. So this is the nearest dated futures, typically once a month. So as you get closer, those windows close a little bit. But about 1 month out, that's the price you see most widely published and talked about on television. The other one is what's known as the spot price or the physical price, basically today's price. What could I get it for today in relative terms there instead of a month from now? And you often see that the today price is a little bit lower than the future price. And there's a reason why, and that's essentially kind of the friction of storing, of transporting, the logistics of actually having physical oil. So that's a cost that isn't necessarily baked into the price itself. And so you see that discount in today's price, you add that friction back, and you end up with something that roughly equals the futures. So that's maybe a way to think about it. But it's anything but what we're seeing today. So if we throw this chart up here on the screen, what you see in the blue line is the physical price minus the futures. So typically you'd see that around zero, maybe even slightly negative. So if we go back to 2008, we see that the futures price is about 70 cents higher, or the physical is 70 cents cheaper, better said. Negative would be the way you'd view it on this chart. Over time on average. You see it kind of trading between a plus or minus $2 range about 65% of the time, or a plus or minus $3 about 85% of the time. So generally a pretty tight line around that. We've seen that very differently since the end of February. So you see that number, -1, 1.5, that was right before the most recent escalation occurred. And you see that move up to 8, see it spike to over 35 and come back down, at least as of Friday, back down to 8. So let's talk about some of this activity here. And really, we see this type of move. We see that spread become positive when there's concern about supply. And obviously, this is a historic concern about supply, which is why you saw that spike to 35. But if we put this in context, the only other time since 2008 we've seen anything approaching this was 2022. When Russia invaded Ukraine, we saw a couple of spikes, but really only lasted a day or two. So earlier in that year, we saw it spike up to 18, come back down to 11, and it was in single digits the rest of the time, really. One other time it hit just barely right at $10, but again, spent one day there and came back under. So really, we have a historic view of this and what is happening in terms of the tightness in the market and the concerns of investors and users and anyone who's related to the oil markets altogether. So really, two conclusions we would tell you to draw here. The first is based on a question, which is right? Are the futures prices right, which are lower, or the physical today price, which is higher? Which one is correct? And in our estimation, frankly, the truth is in the middle. So if we think about, what actually happens here, and that's really the second point is, how does this get resolved? And so if we just take a hypothetical trip here and say, hostilities cease today, the strait's fully open today, everyone can produce again at the capacity they did before the war. Really, honestly, all three things aren't necessarily possible, certainly not that quickly. But let's just say hypothetically they are. If everything's working right, it would take 3 to 4 weeks for that oil to make it to wherever it needed to be in the world. Another 2 or 3 weeks for that oil to be refined or changed in a way to where the end market could use it. So we're 6 to 8 weeks out. So when we say the truth is in between, today's price and the futures, it probably is from a practical standpoint. And then the other point to say, is it closer to today's price or closer to futures, is really how long those three things I mentioned take. How long is it before the hostilities are over? How long is it before the strait can be open and there's a free flow of all the cargo, but particularly the energy resources that are coming back and forth? And then, how long does it take the countries in that region to begin to produce again at the level that the markets need to normalize again? So those are the hard questions, to be honest. Where the price ends up, again, we think it's somewhere in between. But how long the delay is for all this really is the key to all of this. If you're interested in more, there are lots of folks at StoneX that follow these markets very deeply and much more so than we do on the wealth side. I'd encourage you to explore the YouTube channel here a little bit more, thought leadership page, and there's always ways to reach out to various folks at the firm if you'd like to know more. So thanks for your time.